When the European Central Bank issued its cheap 3-year loans, shares jumped around the world as the pressure on Eurozone bank funding eased. Under the so-called longer-term refinancing operation, or ELTRO, European banks could borrow from the ECB for 3 years at very low rates of interest. The ELTRO was widely hailed as the defining policy measure by ECB President Mario Draghi. But there are few left today that think it will save the euro.
People thought when the ECB pumped in all the cheap money in December and again in February that it was the equivalent of quantitative easing, of QE in the UK and the US. That money flowed via the banks into the sovereign bonds, which many people, including me, didn't really expect to happen, but it does seem to have happened. The problem is it's now leaking back out of there. The liquidity went initially into particularly Italian and Spanish sovereign bonds, drove yields down a lot. Now it's leaking back out, it's going into Germany, and German yields are going down. Of course, Germany doesn't need that money, Italy and Spain need it.
The optimism in the markets after the ELTRO helped power a rally in Spanish and Italian bonds back in January is now looking misplaced, with the size of Spain's debt crisis really exposing the limits of the ECB's help. Concerns are growing too over Spain's ability to turn round its struggling economy while introducing savage austerity measures. Its bond yields climbed this week to unsustainable levels of 6%. Investors, meanwhile, are starting to worry that Spain might be the next country in line for a bailout.
There is very much a feeling that Spain is hostage to what bond market investors think and do and buy and sell. So the government's budget came in for quite a lot of criticism, the central government budget, from different parts of the country for different reasons. Some economists, for example, thought it should have focused more on cutting the government wage bill and less on cutting investment in research and development. That's just one example. But the government says it's doing a lot and has done quite a lot of reforms of one kind and another, and people are watching, if you like, with bated breath to see what's happening in London and Berlin and Brussels, because at the moment, although we're getting public expressions of support from the German government, the French government, the European Commission, it's really the international investors and what's happening to the bond yields that really seems to be deciding whether or not Spain will eventually need a bailout.
It's not yet at the crisis stage that things got to in the autumn. Back in November, Spanish bond yields were a fair amount higher, but some of the indicators are starting to look really very worrying indeed. It's still not really about people expecting a bailout anytime soon. It's more about the higher risk of a bailout. So people are thinking that the Spanish economy is in such a dire state, it's very hard to see how further austerity is going to be able to make its way out of this.
The FT's chief economics commentator, Martin Wolf, says the Eurozone has rescued itself from a heart attack, but it now has to manage a difficult convalescence. And he warns there might still be further attacks to come in the periphery countries.
The problem is we have a huge fundamental adjustment problem. These countries can no longer borrow anymore. Some of them are still running substantial external deficits, which cannot really be financed anymore except by special assistance from other governments or from the European Central Bank. And so they need to shift their output into exports. They need, in fact, a huge export boom. For that, they need to gain competitiveness. They are not doing too badly, but this is going to take many, many years, probably a decade. As long as they continue to have external deficits and their private sector doesn't borrow, they will continue to run large fiscal deficits. They try to close down the fiscal deficits, they're just going to end up with huge recessions, which won't make the fiscal deficits any better. So it's a very long adjustment process. And on their own, I think, without a lot of help from adjustment elsewhere in the Eurozone, higher inflation elsewhere, and therefore really big improvements in competitiveness, I think there's a very good chance they'll fail.
The biggest danger the euro faces remains a collapse of confidence in the markets. And it doesn't look like the ELTRO has brought the debt crisis under control in quite the way many investors were hoping. If the single currency is to survive, the Eurozone is looking at a long and painful road ahead. Daniel Garahan, Financial Times.